Hello everyone, Justin with Deep Dive Stocks here, and today we're going to be doing a weekly review. Every week, Deep Dive Stocks sends out its weekly chat that analyzes the data in the market with special interest or emphasis on SPY and QQQ in order to help navigate the week ahead. In this week's video, we're going to be looking at the weekly chat data that was sent out on the 27th of January, 2023 for the week ahead, which was the 30th of January until the 3rd of February, 2023. We're going to see how VoEx, the Gamma Hedging Heatmaps, the market-wide gamma squeezes, LDPM, and some pretty serendipitous changes in the market helped us navigate even in these pretty tumultuous times, and including a week that had FOMC. So I think it's going to be a pretty interesting video, and so let's go ahead and get started. Let's go ahead and get started with VoEx. VoEx is a tool designed to allow us to visualize the stability or instability on a stock. If you haven't, I would definitely recommend checking out this video if I'm doing the point correctly, and that goes over VoEx with a little bit more detail than we are going to here. I'll also include a link in the description below. Here, we're going to look at SPY's VoEx from the 27th. In order to appreciate SPY's recent VoEx data prints, we should take a quick look at the past to understand how SPY has reacted to and what has provoked instability. Here we have SPY's VoEx. There's several things worth noting here, and the first is the overall pattern or trend that VoEx demonstrates with SPY. Notice that the recent rallies have all been met with a rapidly rising VoEx, and then a VoEx spike, followed by downside. This cyclic pattern on SPY is pretty common for a quasi-stable stock. For instance, we see that VoEx on SPY has predominantly been maintained inside of stability, which is a long-term bullish outlook or long-term bullish data print, but that stability is still pretty flexible. It oscillates quite often, with VoEx rapidly moving slightly into the inhibition zone and then falling down to the propagation zone only to rise back up to stability. This is worth pointing out because this cycle or this cyclic nature, this tentative stability on SPY is approaching its instability phase, the phase where VoEx moves into the inhibition zone on a price appreciation, and this is classically met with some near-term downside. We can think of this as a long-term bullish outlook, but in the near term, the price is appreciating with a little bit too much zeal, or the price is overheating some. As VoEx moves into the inhibition zone, the overheating mounts, and VoEx is telling us that we should expect a little bit of a cool-off period for the overall longer price appreciation. In other words, we should expect some near-term downside. However, one of the difficulties in a price that is overheating is that we don't necessarily know when that cool-off period is going to start. Well, that is, we don't know if we didn't have VoEx. Thankfully, VoEx does give us a heads up in most cases with either the presence of VoEx divergence or VoEx spiking. And if you haven't, I definitely recommend checking out this video. Now, I should definitely have this right because this is the second one, where we go over some of the common findings to watch out for with VoEx, and we go over VoEx spikes and VoEx divergences in that video. I'll also include a link in the description below. So the main point from VoEx last week was that we should expect some bullishness. However, there is a looming short-term, near-term downside because the price is overheating. Thankfully, we can maintain a bullish stance until we see either VoEx divergence or VoEx spikes. So essentially, bullish until proven otherwise. Moving away from VoEx, we can move towards the hedging environment on SPY. A Gamma Hedging Heatmap allows us to visualize the options dealer's obligations in order to maintain their gamma neutrality. In order to maintain gamma neutrality, an options dealer will have to purchase or sell shares. So if we can keep track of an options dealer's obligations or all of the option dealer's obligations on an equity, we can start to visualize when they have to purchase shares and when they have to sell shares. The Gamma Hedging Heatmaps provide this for us pretty nicely. The red indicates when options dealers have to sell shares, and the blue indicates when options dealers have to purchase shares. The crosshairs indicate where that equity's price and IV combination are currently. And with that in mind, we see that Friday's data print for the gamma hedging environment on SPY was pretty precarious. Let's point out some things here that help solidify why this data print was pretty nerve-wracking. The first is that the crosshairs were already inside of selling pressure. This means that on market open or pre-market, as soon as the index starts trading, there is an immediate selling pressure that has to be applied as options dealers have to sell shares into the market. The second worrying finding is that we see with the orientation of the hedging heat map shows us that if the index did fall and volatility rose, that more selling pressure would be applied on the index as a whole. This kind of creates this feedback loop whereby as the price falls, more selling pressure is accrued and causing the price to fall more. So the overall hedging environment for SPY walking into the week of January 30th to February 3rd was pretty precarious. And in fact, that is, or at least that is what started to occur on Monday. We can see that here if we map out the Monday's movements on Friday's heat map. Notice that the spot down and an increase in IV pushed the market further into selling pressure. This potential outcome was discussed in the weekly chat and was identified as one of the main indicators for essentially going short for the rest of the week. The idea being that it is pretty hard to overcome such selling pressure when a drop in your price induces more selling pressure. Essentially, the market can really only recover from that once that selling pressure subsides or a sufficient amount of organic bid enters the market. However, and I guess thankfully for the bulls, Monday's hedging environment experienced a very drastic shift. You can see that here. With a sudden switching of polarities providing substantial purchasing support both in the immediate term, remember the crosshairs are in blue and that's the current price and volatility for a equity or in this case SPY, but also we see that if the market were to fall, whereas before more selling pressure would occur, we now have purchasing support. With the additional purchasing support provided by Monday's polarity switch, the rest of the week saw a continued progression towards gamma neutrality. Moving towards individual equity hedging requirements, if we zoom out to the market as a whole, we can get a feeling for the hedging requirements market-wide by keeping tabs of the market-wide gamma squeeze counts. The market-wide gamma squeeze counts count the number of gamma squeezes in the market. Here we see the market-wide gamma squeeze count data print from Friday the 27th. The blue line is SPY, the gold line is the 5-day running average, and the black line is the overall trend for the behavior of gamma squeezes. One thing to note is that when that trend line is above zero, meaning that the number of gamma squeezes is increasing, the market typically experiences a downturn in price, versus when the trend line is below zero, indicating that the market is experiencing a net decrease in the number of gamma squeezes. Notice that the market typically rallies pretty well. In other words, when the trend line is above zero, that is a bearish outlook, and when that trend line is below zero, it is a bullish outlook. And walking into the week of January 30th to February 3rd, we see that the trend line was below zero and a net destruction of gamma squeezes was occurring, which is a bullish data print. And indeed, that is what was experienced as the number of gamma squeezes market-wide dissipated throughout the week up until Friday. But it did experience quite a nice decrease in gamma squeezes. So overall, we have VoEx saying that longer-term stability is tentatively approaching, but we do have this near-term downside to expect by way of VoEx moving into the inhibition zone. Additionally, we had the gamma hedging environment initially showing very bearish data prints, but a very serendipitous change on Monday provided enough purchasing support to usher the market back up into gamma neutrality. Additionally, the number of gamma squeezes throughout the market decreased throughout the week, which is a continued bullish outlook. These data are great, and they do provide a statistically significant outlook for future price action on the market. But these data are produced daily at the end of the market. So it would be helpful if we had something that we could monitor in real time during the trading hours in order to help understand where the market is expected to go. Thankfully, we do have such a tool, which is LDPM. LDPM, or Liquidity-Dependent Price Movement, is a metric designed to help us monitor liquidity in real time and give us a bearish or bullish outlook depending on how liquidity is evolving throughout the market. And real quick, if you haven't, I definitely recommend checking out the LDPM video here. that goes over LDPM in a little bit more details, or you can read LDPM's primer, which I'll include a link for in the description below. And in monitoring LDPM on the hourly interval on SPY throughout the week, we see some pretty notable findings. The first is we see on Friday right at market close, LDPM experienced a bearish crossover, which means that the price fell below LDPM at the start of a candle open. And this bearishness continued until Tuesday morning when finally a bullish LDPM print occurred, ushering a bullish outlook on the market. This, in combination with the polarity switch of the hedging environment, provided some pretty substantial bullish prints for the rest of the week. So even though we were using Monday's price action to influence our outlook for the rest of the week, which on the surface was bearish because of the price decline, the rise in volatility, which pushed the market further into selling pressure, we see that on Tuesday, with both the polarity switch from the hedging environment and the bullish crossover from LDPM, that narrative started to fall under the weight of the new data. And we see that per LDPM, the market maintained its bullish outlook until Thursday at market close when a pretty aggressive red candle pushed the price below LDPM, where it predominantly stayed for the rest of the week. So overall, LDPM provided some pretty substantial outlooks for the market as a whole, but in combination with the known hedging environments, with VoEx's analysis of the market stability, and with monitoring the market-wide gamma squeeze counts, these became some pretty potent data to be able to navigate what is a pretty turbulent market right now. And especially with an FOMC, it's pretty fun to see these data work together in such harmony. So overall, how did these data help us prepare for the week ahead and navigate inside of that week? I think it did pretty well. We expected downside, and that is exactly what Monday gave us. Now, this expectation did originally extend for the rest of the week. However, with that polarity switch on Monday, the LDPM crossover, and the continued destruction of gamma squeezes, that bearish outlook was very confidently and quickly overturned for a bullish outlook. However, VoEx still maintained its position at or near the inhibition zone. The market still climbed up the selling pressure wall. So although there was a bullish outlook, there was still a very near and real possibility for a bearish downturn. Thankfully, LDPM on Thursday told us this downturn is most likely occurring right now when it experienced a bearish crossover at market close. So overall, it was a pretty exciting week. It was fun to see the data work together and offer such insights, and I'm pretty excited for the weeks ahead. That's all I have for you guys today. My name is Justin. If you happen to like this type of data and data analysis, feel free to like and subscribe. And if you really like this type of data, I say head over to deepdivestocks.com, read up on some of the primers, and see if these data could provide any use to you. So, all right, guys, that's all I have for you, and I'll see you guys next time. Bye.